All right, let's cut to the chase and talk about Fubo. The current snapshot, the stock, is trading around 3.48 with a market capitalization of approximately 1.19 billion. The 52-week range is a wide one, from a low of 1.21 to a high of 6.45, reflecting the volatility and dramatic shifts that have defined this company's journey. Let's get into the details that matter. The big picture, Quires 2, 2025, and the Disney deal. The most significant and recent news shaping Fubo's narrative is the definitive agreement with Disney to combine its Hulu, Jiaon, live TV business with Fubo. This is not a small-time partnership. This is a transformative event. Disney, a behemoth in the media world, will take a controlling stake of approximately 70% in the new combined entity. This deal, announced in early 2025, has sent a shockwave through the industry and is the primary driver behind Fubo's recent price movements. This is a deal predicated on synergy and scale. Fubo's existing management team, led by CEO David Gandler, will continue to run the newly combined company. The goal is to create a more competitive and consumer-friendly virtual MVPD multi-channel video programming distributor that can better compete in the crowded streaming landscape. For Fubo, this means access to Disney's premium content, including ABC, ESPN, and all of its related channels, which is a massive win for a sports-first platform. The merger is expected to close between late 2025 and early 2026. This timeline is crucial, as the stock's future movements will be heavily influenced by progress and regulatory approvals related to this transaction. The market's initial reaction was overwhelmingly positive, with the stock skyrocketing after the announcement, showcasing the high level of investor enthusiasm for this strategic move. Q2 2025 earnings, a turning point. While the Disney deal is the headline, the second quarter 2025 earnings report provided the fundamental data that gave the company its current momentum. Fubo shattered expectations on multiple fronts. Revenue beat. Total revenue for North America came in at $371.3 million, a significant beat over the anticipated $353.72 million. This shows that despite the competitive pressures, Fubo's core business is still generating strong top-line performance. Surprise EPS. The company posted a surprise positive EPS of 0.05, crushing the forecasted loss of 0.05. This is a monumental achievement for a company that has historically operated at a loss. It's a sign that the focus on operational efficiency and cost management is paying off. First quarter of positive adjusted EBITDA. This is perhaps the most critical financial metric to watch. Fubo achieved its first ever quarter of positive adjusted EBITDA, a milestone that signals the company's path to profitability. An adjusted EBITDA of $20.7 million is a massive turnaround from the previous year. It shows that the business model, which many have questioned, can indeed be a profitable one. Subscriber dynamics. Here's where the nuance comes in. While the financials were strong, North American paid subscribers saw a year-over-year decrease of 6.5%, totaling 1.356 million. This is a red flag for some investors, but it must be viewed in context. The company is actively focused on a path to profitability, which may involve shedding less profitable subscribers. Furthermore, the pending merger with Hulu, Jiaon Live TV, makes subscriber growth a less critical metric in the short term, as the combined entity will have a much larger subscriber base. The company has even paused providing future guidance on subscriber and revenue numbers due to the pending transaction, which is a clear signal that the merger is the primary focus. The analyst's perspective. A bullish consensus with caveats. The analyst community is largely bullish on Fubo, with a buy consensus rating. The average price target is currently around 5.35, suggesting a significant upside from current levels. The range of targets is wide, from a low of 4.25 to a high of 6.4, indicating varying degrees of optimism. The bullish case is built on a few key pillars. Synergy with Disney, Hulu. This is the most compelling argument. The combination of Fubo's sports-first platform with Hulu Jiaon, live TV's broad entertainment and news offerings, creates a formidable competitor to other streaming giants. The new entity will have an enhanced content library and a more robust ecosystem, which could drive subscriber growth and reduce churn in the long run. Path to profitability. The positive adjusted EBITDA in Q2 is a game changer. It shows that the company's business model is viable and that management is capable of making the tough decisions required to achieve profitability. This shifts the investment thesis from a pure growth story to a growth and profitability story. which is far more attractive to a wider range of investors. Ad revenue potential. Fubo's strategy has always included a significant focus on advertising. With the merger, the combined platform will have an even larger audience, making it more appealing to advertisers and potentially driving a new, high-margin revenue stream. However, a wise investor must consider the risks. The merger is not a done deal. While it has been announced, it is subject to regulatory approval, which could be a lengthy and unpredictable process. The current subscriber decline, while contextualized, is still a concern that needs to be monitored. Furthermore, the streaming market is a brutal battlefield. Competition from legacy players like YouTube TV and new entrants is fierce, and pricing wars are always a possibility. What investors should be watching now? Merger progress. This is the most important factor. Any new updates on regulatory approvals, timelines, or potential roadblocks will directly impact the stock price. The rescheduling of the merger to a slightly earlier window is a positive sign. Future financials. While Fubo has paused guidance, the next few earnings reports will still be crucial. Investors will be looking for continued improvement in profitability metrics, like net loss and adjusted EBITDA. Even if subscriber growth remains muted, insider activity. Recent reports show that Fubo insiders have been selling a significant amount of their stock. While this can happen for a variety of reasons, it's a trend that warrants attention. A consistent pattern of insider selling could signal a lack of confidence from those who know the company best. Market sentiment. Short interest has recently increased, which indicates that a significant number of investors believe the stock will go down. This can create volatility, but it also sets the stage for a potential short squeeze if the company delivers unexpectedly good news. The bottom line. Fubo is not for the faint of heart. It is a highly speculative stock with a wide range of potential outcomes. However, the recent Disney deal has fundamentally altered the investment thesis. The company is no longer a small independent player in a crowded market. It is now a key part of a larger, more powerful streaming ecosystem. The achievement of positive adjusted EBITDA in Q2 2025 provides a tangible sign of financial discipline and a clear path to profitability. For those who believe in the long-term vision of a combined Fubo, Hulu Live TV, and are comfortable with the inherent risks of a pending merger, the stock presents an intriguing opportunity. The current valuation, especially when compared to the analyst price targets, suggests there is significant upside potential. However, this is a stock that requires constant monitoring and a deep understanding of both the company's fundamentals and the broader media landscape. Do your own due diligence, but recognize that the game has changed for Fubo, and the next few quarters will likely be the most telling. The future of this stock is now inextricably linked to the success of its union with a media titan.